Hello, this is Schulz, and today I would like to discuss with you what's next for the pork market. I will note that this presentation was recorded on Friday, July 21st, 2023. We'll just cut to the chase and talk about first, what are the forecasts for lean hog prices? I like to present forecasts as a composite when we look at three different forecasts here. So first I'll look at the Livestock Market Information Center, then USDA Economic Research Service, and then forecasts based on futures prices adjusted for an Iowa, Minnesota basis. And that'll be the forecasts that I typically use. And if we look back and first look at 2022, those were the second highest prices ever to 2014, where prices averaged roughly $96 per hundredweight, just under what we've seen in 2014 of over $100 per hundredweight. As we entered 2023, we've seen prices about 14% softer, and then the second quarter of 2023 were about 23% lower than we've seen in the second quarter of 2022. Now, there looks to be some slight improvement as we get into the latter part of 2023. Maybe the fourth quarter only 10% lower, but roughly we're looking at about 16% lower prices in 2023 compared to 2022, and then some possible improvements as we get into 2024. Now, if we look at historically what returns have been, and I've brought returns here back to 1974, you'll see that what we're experiencing currently in 2023 into 2024 is some of the worst stretch ever in hog production as we look back to 1974. In particular, as we look at an annual average, losses in 1998 were roughly $27 per head for a farrow to finish operation. In 2023, forecasts are currently for a $30 per head loss, and then piggybacking that with a $16 per head loss, which would be similar to what we've seen in 1999. So that 2-year stretch is possibly the worst ever in pork production as we look back historically. Now, as we talk about prices and returns, I think it's important to keep in mind the difference between nominal prices and values and real values. So as we've seen inflation get as high as we've seen since 1981, those prices and profits we're seeing for producers are not stretching as farther, right? And so as we look at the difference between the red line here and the blue line, the real value, those relatively strong prices in 2022, for example, were much lower than what we'd seen in 2014 from a receipt standpoint because of the value of that dollar wasn't as high. So keep in mind that as we're seeing prices much lower, there's also the impact of inflation on those dollars received. And when inflation is sometimes looked at like this, so the percentage year-over-year change, as we note, we're seeing inflation levels got as high as 9.1% in June 2022. That you have to go back to 1981 to see levels that high. Now, we have seen inflation levels come down to 3% year-over-year here in June 2023. So we have been in a period of disinflation over the last 12 months, as you've seen that rate slow a little bit in the levels of inflation. But important to keep in mind is these still are the highest prices we've ever seen in the basket of goods that we're purchasing as we're looking at the consumer price index. Another way I like to look at inflation is $1 in June 2023 is worth only 32.78% as much as it was in 82 to 84, which is that base period for the consumer price index. And so it shows the impact of that purchasing power over time. So even though we've seen disinflation going on, we're still seeing some of the highest prices ever for that basket of goods that we're purchasing. Now, when we look at that basket of goods, we can go through different categories, and I pulled out some of the food categories here. Well, you say food is 5.7% higher, but meat is actually only 0.6% higher. compared to 2 years ago. So there's a lot of variability in that basket of goods and the prices being received. And when we think about consumers paying prices for meat, that has an impact certainly on prices for the pork cutout as well as hogs in this case. Now, one more way to look at inflation here, and we can look at the wage rate as it compares to inflation. So if wages are increasing as fast as inflation, there's no impact, right? And here I'm looking at median wages, understanding there's a lot of variability in wages. And really, we did see a spike in wages there into the second quarter of 2022, or 2020. Excuse me, but that's not when inflation even started, right? When we started seeing inflation really pick up was into 2021 and into 2022. And in that case, wages really stalled, or actually the percentage change actually fell year over year. So that showed the impact of inflation. Another way to look at it is Purdue University has a really cool dashboard to look at what 1 hour of work can buy you for individual items. And so these individual items are data collected from the Bureau of Labor Statistics. I'm going to compare February 2020 to June of 2023. So in February 2020, you could buy with 1 hour of work 9.1 pounds of ham, and you could buy 17% less of that in June 2023 because of that inflation, right? Prices increase faster than that 1 hour of work or wage rates increase. You see across all those goods, we can buy less of everything except for actually bacon. You can buy about 4% higher bacon. We'll talk a little bit more about that later. Now, as we've seen meat prices all change, pork in particular was 9% higher in 2022 compared to 2021, but actually in June 2023, it's actually 5% lower than it was last June. Now, as we look at demand, we're going to compare the prices. So we've seen softer prices as well as we've seen decreased consumption. And so when we take that together and adjust for inflation, we've seen demand decrease in the first quarter of 2023 almost 7%. And you'll note that continues a run of decline in demand. So we've seen the third quarter was down a tick. Fourth quarter 2022 was down notably 13%, and then the first quarter 2023 looks to be was down again. Now, that's the bad news. We've seen demand soften a bit for pork, but as you look at those red lines, you'll see that even where we were in the first quarter of 2023 is still a relatively strong demand period compared to historically. So yes, 2022 was historically strong, and we're coming off those historically strong levels, but we still remain relatively high compared to historical levels. Now, the bright spot about demand has really been export. So this is data through roughly half of the year, and we see exports from a total commitment standpoint up 11%. This is volume data, so it doesn't compare value, it's just the volume here. But that is notably better than we had thought early on. So forecasts for 2023 were actually below year-ago levels. USDA has revised that up to anticipate 9% higher exports in 2023 compared to 2022, and then add another 1% increase potentially in 2024. This is notable because if we wouldn't have had this strong of export demand, that would have suppressed prices even more. So as we look at globally impact on pork production being down and very strong demand still, we're seeing U.S. Be able to maintain or increase some share on the export market. Now, as you look, a lot of the optimism here for that total commitments or exports is still in outstanding sales. So it's product that's been purchased but not yet delivered. That's especially when you look at Mexico and Japan. When you look at their accumulated exports to date, they're actually down year over year, but single digits. A lot of the growth has been in countries like Chile, Dominican Republic, Guatemala, where we've seen some large increases year over year. Now, as we look at the balance sheet here, 2023 is forecast to be about 1% higher slaughter, but lower carcass weight, which should bring production down to close to 2022 levels, maybe slightly larger. I will note that per capita consumption is notably declined. That's due to the larger exports already accumulated, as well as forecasts going forward. 2024 looks to be a slight decline from 2023 levels. And that's kind of indicative of what we've seen in current hog and pigs reports, as well as the economic situation ongoing. Now, I will note, I still believe that the hog cycle does exist. It looks a bit different, especially when we look historically. We don't see as wide as swings here, but we still do see patterns in year-over-year slaughter that give rise to that cycle. Now, I will note, it's maybe a bit of a surprise that we're seeing the production levels at where they are currently in 2023. Remember, forecasted 1% year-over-year gain. In the first quarter, we were actually up 3.1%. But due to biological lags, the production we're consuming now, those decisions were made 10 to 18 months ago. And so that production, it's working its way through this supply chain. I think there's also a lot of asset fixity, a lot of asset specificity that's holding some of this production levels where it's at, even though we're seeing some of the worst economic times we've ever seen in pork production. Now, the recent hog and pigs report gave some indication of where we see some inventory levels going forward. When you look at the breeding herd, was only slightly below a year ago levels. I think there was some anticipation that we would see that decline a bit more, and maybe anticipate that for some of the coming quarters. Market hog inventories were very close to year ago levels. If there was any real surprises in this hog and pigs report that are highlighted in blue here, the surprises being that we've seen farrowing intentions are very pessimistic for the next 2 quarters. And maybe that's not too surprising, but I think it's a bit surprising when you look at the size of the breeding herd. And we'll talk a little bit about that here in a bit. The other big surprise was looking at the pigs saved per litter. So productivity, what had been roughly about 0.5% year-over-year increase the last several quarters, was up 3.3% year-over-year. So even blew by some of the 1% to 2% high rates we've seen recently. So even though we've seen fewer sows farrowed, down roughly 2.4%, with those larger pigs saved per litter, you actually seen a larger March-May pig crop, again, because of that productivity. Now, as I mentioned, USDA had the slaughter levels pretty close to year ago levels. As we look at slaughter since June 1, it's actually been up 0.9%. The report said it should be actually down 0.2%. So I think there'll be some revisions in the next report for September, likely. This also could be an indication of maybe pulling some of those hogs ahead a little bit. And so we'll see as slaughter levels shape up over the coming weeks and months, how close those inventory levels were to what USDA had projected. For year to date, we're up 1.2% in slaughter levels. Now, hog weights have bottomed or are close to bottoming. As you look at producer-owned hogs, those weights are as light as they've been since 2013. With the high feed costs, you've really seen those weights decline, especially since April-May time period, and have maybe bottomed out here as we got into the summer months. Packer-owned hogs, you've seen those continue to decline. I think there's been a lot of incentive for packers as of late to pull on packer-owned hogs, as we've seen prices get much stronger for hogs across the board. And so you've seen that narrow up a bit between producer and packer-owned hog weights as of late. Now, those farrowing intention numbers, as I alluded to, are very pessimistic for the June, August, and September, November period. Those intentions would be the smallest since 2013. If they come to fruition, are part of the actual sows farrowing. Now, when you look at where those sows farrowing are, compared to the size of the breeding herd, there is some discrepancies there. because given the size of the breeding herd, you would expect the number of sows farrowing to be larger, to be in a percentage rate compared to historical levels. So as you look at that blue line here, that's the forecast for the next quarter, this June-August period, would be 47.9% breeding herd utilization rate. That would be the lowest since 2002. So I think that gives a suggestion that USDA will likely have to revise that breeding herd for the June 1 period. So if we're closer to what those sows farrowings actually are from the intentions number, that breeding herd will likely have to come down. Alternatively, you could see producers say we're going to farrow more sows. And so that would also increase that breeding herd percentage. It's likely maybe going to be a combination of both of those, but that's something to watch going forward of what the implications are for the size of the breeding herd relative to the sows farrowing number. Another production reality that you can calculate from the Hog and Pigs report is the litters per breeding animal. And you can annualize this. And I'll note that this is some of the lowest levels we've seen, again, since about 2002 for this particular quarter. And so I think it's something to continue to watch going forward. There may be some changes in production facilities ongoing, and any implications in the farrowing rate may be manifesting here in the litters per breeding animal as we can calculate it from the Hog and Pigs report. So on one hand, we're seeing very high productivity and pigs saved per litter. On the other hand, we've seen a productivity measure here come down notably from where we've seen, or at least where it plateaued several years ago. A bit more on the pig saved per litter. We've seen large increase this last quarter. It's in the dark blue there to really note how much larger this is compared to what we've seen the last several quarters. I think there's a lot of possible reasons for this. As we've seen some sow culling going on, maybe those were the least productive sows, or likely the least productive sows, and so that has helped increase productivity here and increased it. Also, I think as you look at disease incidents, incidents have been lower, at least compared to maybe some historical or recent levels. PRRS levels, some data here out of the Swine Health Monitoring Project, Dr. Bob Morrison's Swine Health Monitoring Project shows PRRS levels have been at some of the lowest levels. PDV levels have maybe been, similar, maybe on a little higher end compared to the last several years. Some swine disease dashboards here out of the swine disease reporting system here at Iowa State University also shows, some of those incidents of PRRS in this case were within the 2 standard deviation baseline. That's the light green here. There's some dark blue or magenta there. That's 3 standard deviations below. Ohio showing a little bit above the baseline. And so this was data from June. So I think this would help back up that increase in productivity if we've seen it, here the last quarter. But as I look at the July 1 from these dashboards, we do see a lot more red here. So incidents with 3+ standard deviations above the baseline from a PRRS standpoint. So again, it's something to watch productivity going forward. We did see that large increase the last quarter, but if we do see more disease, does that put that productivity back down to lower levels? Certainly possible there. Now, early wean pigs and feeder pig prices, I like to look at the cash market here to really give the pulse of this. We're seeing 10 to 12 pound pig prices near where the lows we've seen during COVID-19 disruptions, roughly $10, $11, $12 per pig from a cash market standpoint. 40 pound pigs haven't declined as far or as fast, but still relatively low levels below what we've seen for the 5-year average. So if we look at where hog prices are at, that's certainly contributing to this, but also the cost of production. So this is the Iowa State model here for fair to finish production, estimating costs here. to think about these as break even. Prices that would be needed. 2023, our forecast is for a $98 per carcass weight break even there. That would be about 3% higher than what we've seen in 2022, but on the heels of, rough almost a 50% increase in cost. Now, 2024 is currently forecasted for a modest decline, maybe about 7% decline in cost, but still remain at these very high levels compared to what we've seen historically. As you look at 2016 and 19, that average was about $64 per hundredweight for a break even. Now, it's not just feed prices, and that's what's driving some of the decline expected in 2024. These are prices paid indices from USDA to kind of show you, it's not just feed prices that have increased, it's costs across the board. And when you look at some of these costs, they're really inflationary, that those hikes are here to stay. So as we may see some feed prices start to ease, and we've seen some of that start in these indices, a lot of these other costs are going to stay high, right? And so that certainly has an impact on cost of production, what that new level is for cost of production. Interest rates continue to be high. They're as high as they were in 2006, and certainly adds to that higher production cost. So as I alluded to earlier, 2023 could be that worst year ever in pork production as we look at a $30 average loss using this Iowa State model. And that is a variation from a loss of $58 per head this spring to more modest or smaller losses, $2 per head loss. But as you'll know, 2023 did not have a single month that was profitable as estimated by this model. 2024 still relatively large losses, about $16 per head, with a variability from about 32 to maybe a profit of about $3 per head. Now, that model, I separated out the manure credit there. So we are seeing relatively high commercial fertilizer prices, with our creating still a relatively strong manure credit from pork production. But it's come down from the heights of $10 to $12, more in that range of $7 and $9 currently from a value standpoint. Now, I want to talk a little bit about why we maybe see a bit of variability in those profit levels. So as I noted, we're estimating a $30 per head loss for pork producers on average here in 2023. But that's representing really no one producer, right? We're just kind of using that as a barometer of losses over time. Now, we know that producers market hogs in a variety of different ways, and at times those prices can vary notably. Here I show the weighted average of the prices for the week ending 7/14/2023, and you note that prices were actually pretty close there for that particular week, at least from a weighted average standpoint. But when you look at the distribution of those prices, and this is a tool we have on our Center for Agriculture and Rural Development website, it's a hog price volume and distribution tool. There is the web address for that tool. You'll see that the distribution was from under $90 per hundredweight to about $116 per hundredweight for that weighted average of 102.75. So that creates a lot of variability for prices for producers. Now, those certainly need to be paired with cost of individual producers, but that can cause some variability in those profits, certainly. Now, also, we need to think about opportunities for risk management. Obviously, those opportunities have been few and far between as we look at prices so far here in 2023. But as you look at earlier, or actually late 2022 and early 2023, there was some opportunities to possibly lock in some profitable months and a much lower loss from an annual average standpoint. So take, for example, if you look about this time last year, you could come close to a break-even level for 2023, locking in those futures prices for 2023. Now, as prices eroded through much of the spring of this year, you've seen, much lower projected losses. And now 2024 is similar, looking at a projected loss. Now, prices really started to fall as we looked at about early to mid-March, and fell until we really got to end of May, early June. We've been in a buy signal since really mid part of the June period, which much stronger hog prices. I think the question now, obviously, is where do hog prices go from here? I think we're really in that 82 to 84 range. That's maybe causing a little bit of support from the 80 level, maybe a little bit of resistance from the 84 price level. So I think, giving an indication, if we can push through that $84 price for the October contract, that may show, that we do have a little bit of more support in this hog market. Now I bring this chart up just to kind of remind us of where we maybe are in that price chart. So you could lay that October contract on here, and we would be really back to the optimism point, right? After we started kind of falling in March and hit that low in late May and early June, we've gotten a lot more optimism. So I would encourage producers to, review your risk management plan and look at opportunities for this hog market as we get into the latter part of 2023, and looking at opportunities for 2024, because we've been in an upward market. This has been a market that has gotten some legs and has maybe provided some opportunities as we look ahead. Looking at how the options are currently priced, I think there is a tick less pessimism, maybe is a way to put it, that prices could go lower for that October contract. So I am looking for some upside there. Currently, again, I think looking at maybe that 84 level as a point, if we can push through, would suggest maybe prices can go higher. Now, as you look at what has really been a driver of the strength in this market that we've seen, pork cutout values had been trading in that $80 per hundredweight range for much of the year. And really, as those prices started to really, we got into stronger summer demand, and that brought prices much higher. Now, not at the levels we've seen in 2022 quite yet, but we've pushed past really those suppressed prices that we've seen much of the year. Now, what has driven that increase has been a large part of the belly. So the belly has seen considerable strength from the much lower levels that it showed this year. So really, it's pretty close to year ago levels, and that's indicated here as we look across all those primals. The cutout is currently about $6 to $7 below year ago levels, but we actually see a bit higher prices in some. The picnic, the butt is actually a bit higher. And then we're seeing lower values for the belly, for the ham. I think the ham, we've seen a little bit lower prices as Mexico has a lot of sales on the book, but we've actually seen lower sales year to date from accumulated exports. And so I think, that has weakened that primal a little bit. Now, another thing certainly weighing on the belly is belly stocks have been really high. As we look at cold storage, 47% higher at the end of May 2023 compared to May 2022. I think this is a bit of an indication when we look at food service demand. We've seen domestic demand impact, as I showed you earlier, still remains relatively strong, but I think you're seeing impact on food service demand, certainly as inflation has impacted consumers, and their disposable income and what they're able to spend has impacted their ability to eat out, and we've seen an impact strongly on the belly because of that bacon demand. Now, it's not just producers that have faced very negative margins. So I'd like to highlight here, pork packer margins really reached very low levels in the spring of this year, especially from an integrated margin. So those were some of the most expensive pigs out there. And we've seen those prices or those margins for packers very much in the red ink. Lately, they have increased though. So we've seen as the pork cutout has very much strengthened, we've seen pork packer margins get close to back to break even levels. And even though we've seen much higher hog prices this summer, so it shows you what the support of that pork cutout has done. A few things I want to finish this talk up with is talking about some data that I think we can monitor some current events. So as you know, a lot of questions I get about is, you know, what percent of production is Prop 12 compliant? Because there's not one piece of data out there that tells us the percentage of pork that is compliant or being marketed with those characteristics. And that data still doesn't exist. You know, those numbers out there that California roughly consumes 13 to 15% of our pork production. But the question is how much of that production is compliant. Data I like to refer to maybe start to tell us a bit of this story is looking at the pork cutout, the specialty report from USDA. So you could take that specialty report and the volume or the load count there and compare that to the comprehensive value, which includes all pork except for specialty, right? And if you take that percentage, it's roughly in that 7% range. And why would we look at that specialty report? Well, that special report has programs including but not limited to open pen gestation, crate-free, antibiotic, and so on and so forth. And so when USDA or when this data will be published from Prop 12 compliant pork, this is where they're going to put that data. Now, unfortunately, the data is all in aggregate for confidentiality reasons. So we can't extract what particular production is being sold for open pen gestation, for example, versus another characteristic or a bundle of characteristics. But it will help, I think, provide a barometer of that production. You've seen it start to increase over the last several years. My question is, how much do we see that increase in the coming months and years to come? And is that pair with what we would expect for production needed to fill that California market? Another report is USDA's National Weekly Direct Swine Non-Carcass Merit Premium. And again, it's got an other category that includes several characteristics, including sow housing. And so as we think about, you know, questions about what those premiums are being paid for Prop 12 compliant pigs and understand what those premiums are, those premiums need to last over the life of that investment, but what those premiums are, and hopefully we see some of that data being reported here. Now, with enough volume, it may be that USDA would pull out some of these categories and report those specifically separate. So it might not just be Prop 12 compliant, it might be open pen gestation as an aggregate, but it'll be much more of a disaggregated aggregate. Now you'll see this premium for other, the weighted average has been in that $5 or so range. You know, I will note that I think back in November, we've seen the high end of that range really decline. You know, that could be because one packer stopped offering a particular bundle premium. You could think of a premium that it was kind of like the kitchen sink. It had a lot of these different characteristics. May have been the high end where it was in that $30 to $35 per carcass hundredweight. That has come down more to the $12 range now, which has obviously impacted the weighted average. But this will be another report to watch on maybe helping us give an indication of how those premiums are changing due to changes in production practices of producers. So with that, I'll thank you for your attention. I'll highlight several of the resources that I talked about today are available at these various websites. And if you have any questions or comments, feel free to reach out to me via email or phone. I'd be happy to follow up with you. Thank you.